Michael Galliette, portfolio manager of Tidal Financial Group, is back with us, and here is his outlook for 2023. Michael, always good to host you. Lots to discuss today. Very interesting market setup for the rest of the year that you'll be talking to us about. Welcome back.
Yeah, no, I appreciate it. By the way, I'm every time I come on, I'm reminded I really have to rock a tie clip because I feel like it's such a nice, subtle fashion statement, but very few people actually nowadays use that.
That's one of your catchphrases. Few understand the importance of a tie clip. Few understand.
You do.
I do. But I encourage you to wear one. Certainly adds a nice touch. Michael, you know what else adds a nice touch? Your market analysis. You've been right pretty much every single time we've talked. You've called the bear market in 2022. Congratulations. A lot of other issues you've discussed more on a societal basis. But today we're going to talk about another interesting topic, which is the rotation into emerging markets and your thesis as to why we should do that. But let's back up here for a second here. If you look at the S&P 500 year to date, which is the last 2 weeks, basically a year to date sounds so grand. It's really only been 2 weeks. It's been a good start to 2023, hasn't it?
Yeah, across the board. It's not just in the stocks; it's been in bonds too. But keep in mind that follows what was the fifth worst December for the S&P in history, going back to the Great Depression. I mean, Santa Claus no showed, or at least seems to have showed up late. So yes, good start to the year. And it's funny. I know a lot of people, I think, will largely argue that the turn of the year doesn't tend to mean very much, but sentiment was pretty bombed out ending last year. So mean reversion would dictate that probably we're due for some optimism.
Is that because of a technical rebound, or is the market sniffing out some sort of economic rebound?
Probably a little bit of both. Look, to the extent that the bond market has started the pivot, which is what I believe is happening, not the Fed, the bond market, which owns the Fed. If you look at the way long duration yields have been dropping on the Treasury side of things, that for a moment in time would suggest that you've probably hit peak inflation, that mortgage rates probably drop, that lumber and housing starts to maybe be down less after all the cataclysmic stuff that people have been saying after I said it on Kitco back in like February, March of last year. So there's always these cycles that come out in markets. And by the way, just to be clear, I appreciate the kind words on sort of the market analysis of last year. As you know, my analysis really didn't mean very much for the funds I run, because the funds I run all use treasuries as the risk-off play. So you could have been right in your analysis and your signals, but the expression of being right was the real problem last year. I suspect if last year was the year of the duration crisis, of the correlation crisis, this year becomes the year where things normalize, not in terms of trend, but in terms of intermarket movement, meaning that you start to see the right behaviors kick back in again. And from that, there's a lot of implications for asset allocators, traders, and anybody in general that's interested in markets.
Yeah, I feel like last year kind of hit a lot of people by storm in the sense that all markets came down together with a correlation of one very quickly, very fast, very soon, and caught a lot of people off guard. And now people are starting to feel defensive. Well, not now, but maybe a few months ago after everything already went down. Is that too late?
Listen, there's a general rule of thumb, right? You want to buy dislocations and sell normality, right? I mean, last year was a dislocation. I keep going back to that point that never in history did long duration treasuries lose more money than stocks in a top 20 drawdown for stocks. All the narratives that keep getting thrown around this are nonsense. People say long duration sold off hard because the Fed hiked rates. Okay, except that historically the Fed hiked rates, long duration treasury yields still acted as a safe haven when you had high volatility in equities. The argument that this is because of rates being too low, okay, or because of quantitative tightening, okay, well then explain to me why, as the Fed is selling bonds are getting bid up now, right? So there's a lot of narratives I think that got countered. Look, I think there's. I always go back on Twitter. I say, unpopular opinion, you can be both bullish and bearish at the same time, right? Because it's always a function of time frame. So I think the way the year is played out and the way certain sectors are now behaving to start 2023 is favors, conditions that would be conducive for risk on sentiment for equities. You look at consumer discretionary stocks, they're bouncing relative to staples. You look at small caps starting to lead. You see this kind of continuation of the things which got bombed out on the cyclical side, starting to outperform, while the defensive sectors, staples, utilities, healthcare, those out of the gate are pretty weak. Now, should that continue, that would be exactly what you want to see in an environment that favors the bulls. But people forget there are lags when it comes to interest rates, the economy, and markets. We went through the fastest rate hike cycle in history. It was a devastating period for bonds. it was not really a devastating period for stocks in the sense that you did not have a VIX spike. You did not have a credit blowout. I think that's still coming at some point this year. So if you think about timeframes, bear markets make fools of bulls and bears. You're probably going to have a continuation higher, given the way their year played out. But at some point, there's going to be a tail event, I suspect. And if that's the case, that means you get back to that historical flight to safety behavior in treasuries.
I'm gonna just slightly challenge you on this tail event. Of course, nobody can predict exactly what a black swan could be. But if you take a look at the markets, and of course, you just said that we have a possibility of a rebound of a bull market. If you take a look at where yields are heading, which is down from a few months ago. If you take a look at the employment numbers, just the last numbers that came out, ADP was hotter than expected. Jobless claims were lower than expected. It seems. Hold up. Can I make the statement that the recession is over, or if it hasn't come yet, it's not going to come?
That is the big question, right? And so, look, first of all, in general, when you're below a 200-day moving average, that tends to occur when you're in a recession. So we can quibble about the technical definitions. We're not in one, you can argue technically, but there are a lot of interesting things that you can argue last year that would have suggested we had been in one for a while. So I don't know the real answer to that. All I know is that to some extent, markets don't really care about whether it's a recession or expansion. What they care about is what happens, 9, 12 months later.
I think a lot of people stay on the sidelines, just really want to know the answer to this question. When is the right time to rotate back into stocks and risk assets? Is it now? Is it later? Is it too late?
Yeah, it depends on your time frame. So if you're an active trader, I would argue that the conditions are there for a continuation of the move higher in equities. Okay. That doesn't mean you can't have a big decline. I mean, I was very bullish October 2nd. I was then very bearish on December 2nd. Fifth worst December, no crash, but still was a nasty period. All the signals that I use that have historically been proven to be leading indicators suggest that in the near term, now we're back in a sunnier environment to start to speed up in. But if you're going to be a long-term investor, you got to be mindful of still a credit event that might be out there. But I'm going to argue even more importantly than that, the last decade has been dominated by large caps, by U.S. Why is that? Well, because of QE3 and zero interest rate policy, both of which are now gone. You don't have quantitative easing. You don't have zero interest rates. All the stuff that made U.S. stocks pull away from international is no longer a tailwind for momentum players. So if you're really going to be forced to buy into stocks, sometimes the best thing to do is to go into the biggest laggard, which really is what emerging markets are. All
right, we're going to come back to that. But first, I want to touch on the tail risk credit collapse that you alluded to several times already. What exactly is this credit collapse that you're talking about? Can you give us some more color?
So to be clear, whenever the people say the Fed raises rates until something breaks, or they say it's an S&P put, all this is nonsense. It has nothing to do with the S&P. If you were to look at the VIX index on the S&P, volatility, and compare it against credit spreads, you'll see a 1-for-1 relationship, meaning when you have a VIX spike, when you have a big decline in stocks, credit spreads will blow out. Junk debt becomes junkier because in the bond market, then the perception of high volatility in equities means default risk is increasing internally in the bond market. That's what the Fed cares about, right? They care about the impact on the real economy as far as credit spread movement. Now, you did not have credit spreads blow out. What's remarkable about 2022, despite the carnage in the bond market, is that it was largely duration driven. It was largely not a situation where the market is reassessing the potential that debt issuance goes bankrupt. It was just a shift in the entire curve. If you believe that there's still a VIX spike, you must believe that there's a credit spread event coming. And if that's the case, that's probably where the Fed starts to then reliquefy, assuming it gets out of control. I would argue that the Fed actually wants to see spreads widen somewhat. They want to see some degree of defaults in the economy because the fastest way to kill off demand inflation is to kill off companies.
You mean corporate default, not sovereign default?
Correct. Okay. Corporate default. Right.
Okay. Why would the Fed want this? This would, if out of control, would completely kill the economy.
Yes, if that's the tricky part you hit on. If out of control, the question is if they want a little bit of spread widening, a little bit of default, can they prevent it from snowballing into a much bigger thing? The history of the Fed would suggest that they suck at that, right? So probably not, and that's why I go back to I still think at some point there's a major VIX spike coming. At some point there's a major credit spread blowout event coming, but you may need to suck in more bulls before that happens.
Is that independent of an economic slowdown or a recession? Think about it this way. During a recession, businesses go bankrupt. That's normal. And you're going to get credit defaults anyway, right? Are you saying that this could happen independent of a recession?
Yeah, I mean, certainly, I think if you look at the six major declines in markets for the last 40 years, three of them have nothing to do with recession. It was just market-driven spread blowouts and events, right? So it's not, you can have a tail event in equities without there being a recession driving or wagging the tail, so to speak. So certainly possible. Question becomes, where does that come from or what's the catalyst? And the truth is nobody knows. I mean, I suspect that as much as I just argue that in the short term, discretionary stocks are due for a bounce and all these things look like they want to suggest risk on is here, at some point, the reality for consumers will hit. At some point, the reality for housing will hit, that it's going to be probably a period or a part of the economy that's going to be in the doldrums for a couple of years at least. And that could just cause, if everybody starts pulling back on their spending, that alone could create an event.
Right. So walk us through the ripple effect of this credit collapse. What's going to happen to everything else? You mentioned housing. That's one.
Yeah, that housing would be, I mean, it's like any other sort of major financial crisis, right? It ends up being too much illiquidity as opposed to too much liquidity, right? And that's where the Fed suddenly has to step in. The thing is, when you're already highly levered, every single one of these types of events, when they occur, tends to be much more amplified because there's more leverage against it that you've got to reliquify, to protect. So who knows? It's one of those things where I think the setup is there at some point. Again, I think this year. I've also seen some studies, and I need to do admittedly some more work on this myself. But if you look at a lot of the small business loans that happen, around the time of COVID, they apparently mature in 2024. So, well, if that's the case, the market would start to sense that earlier, right, in 2023. So it could be one of those things where it's the rollover of some of these COVID stimulus, which ends up being the real spark for a lot of this.
I want to talk about the Federal Reserve now, monetary policy, and that leads to your thesis about emerging markets. Now, you have some interesting charts showing us the effects of QE on monthly returns. So in this first chart, you've got three panels here, pre-QE3, QE3 to Fed hikes, and then since March 2022. And it's interesting to show that the emerging markets have reacted differently to quantitative easing than domestic markets, namely the S&P 500. Can you just in layman terms explain this chart?
Yeah, and by the way, this is like a very personal thing for me. So I launched my mutual fund, ATAX, September 12th in 2012, a day before quantitative easing 3 began. And part of the rules-based approach with my mutual fund is that when it goes risk on, it tries to play relative momentum in emerging markets. The idea there is that up until 2012, there was co-movement. When the U.S. would run up 1%, emerging markets would be up like 2%. It was just a levered play on U.S. stocks. So here comes QE3. And if you notice on the distribution chart, basically what it shows is that in the quantitative easing 3 period of 2012 until the first hike that happened last year, you see more extremes on the downside of emerging markets, whereas U.S. stocks didn't have a fatter tail on the left. In other words, U.S. stocks were less likely to have major declines, while emerging markets were more likely to have major declines. The thing is, before quantitative easing 3, the U.S. and emerging markets were both likely to have major declines, right, on terms of losses, daily, weekly, monthly. So the effect of quantitative easing 3 is that it destroyed the tail for U.S. stocks. It made the U.S. the most attractive place to be because it suppressed all volatility, suppressed all risk, while emerging markets still had the same dynamic they had before quantitative easing 3. It's interesting now, and that also is what broke the correlation, right? If you look at that clearly, there's another chart I have that shows that if you look at the correlation of emerging markets to the U.S., was very tight up until quantitative easing 3, structural break, and then suddenly the U.S. pulls away from emerging markets and everything else. Now, as the Fed has been hiking rates, guess what? The correlations are reasserting. Guess what? The tail risks are starting to look more similar between the U.S. and emerging markets. This is a really, really important dynamic from a cycle perspective, because if I'm right in my theory that quantitative easing 3 was a real structural break in the relationship of U.S. stocks to emerging markets in particular, and now you reassert that correlation, then if you really are going to be an investor, maybe the place to be is outside of the U.S. That the playbook which worked because of the Fed's suppression of volatility needs to be rethought from where to get returns from.
Tell us some practical ways, Michael, to invest in the emerging markets.
So as you know, there's a lot of people that don't want to touch China. All right, a lot of financial advisors I talk to don't want to touch China, which maybe why you actually want to consider China, right? Just from a contrarian perspective, because no matter what anybody thinks about China and the risk on the geopolitical front of what they could do, the reality is there's a price for everything. All right, so I suspect if you really want to, get creative, China is probably the place to be. Now, having said that, there's a lot of other emerging markets you can argue for, like India and a lot of the Latin America type of ETFs that are out there. But it's a broader argument, right? It's like we know that QE and zero interest rate policy benefited large cap U.S. tech. Okay, everyone says that dynamic is done. Okay, well, if you look at a lot of the emerging market ETFs, a lot of them don't have tech. A lot of them are actually value sectors. Anybody that argues that value is going to outperform growth, they're basically making an argument for emerging markets. Anybody that's going to argue that commodities are going to outperform stocks, they're making an argument for emerging markets. Anybody that's going to argue that energy would outperform tech is making an argument for emerging markets. So it's a broad allocation play. What specific countries, that's up to the listener, but I think it's more of a mindset of shifting out of domestic developed.
You wouldn't buy a basket ETF, like a emerging markets ETF? BlackRock has one. I can't remember the ticker.
Yeah, there's several of them. Yeah.
Yeah.
I mean, I do it on a broad basis for the risk on side of my mutual fund ATAX, just to play that momentum. And the other part of this is also like, it's interesting, right? Because it's like, whatever happened to the dollar wrecking ball, right? Just as everyone was railing about the dollar wrecking ball, it got wrecked. And, a weak currency, a weak dollar, it's like the dollar is no longer the best inflation hedge. Can I say that tongue in cheek? But that's what happened last year. Well, a weak dollar would also be supportive of emerging markets. So everything's kind of saying the same story here. And I go back to, if it really is because emerging market momentum is not positive when you have zero interest rate policy, then it stands to reason any kind of positive interest rates are actually good for emerging markets, despite the popular narrative.
I showed this chart last week to another guest, and this is a chart from a research firm called Alpine Macro here in Montreal, actually. And what this chart shows is the S&P 500 versus the S&P minus the biggest tech stocks in the index: Facebook, Amazon, Alphabet, Google, Microsoft, Tesla. And if you strip away these stocks, what you see is an index that has actually done quite well in the last quarter. It hasn't skyrocketed, but it's more or less stayed flat while the entire index fell, which shows that the tech stocks, the biggest tech stocks within the S&P 500, were largely responsible for the decline over the last quarter or so. And it's also interesting that this decoupling has just started to happen since a few months ago. Does this tell you that perhaps if you just not invest in tech stocks domestically, you might do well this year? Or perhaps is it telling you a different story?
I'll take it a step further. So I go back to, I mentioned energy versus tech. So if anybody that's listening were to do a simple ratio of energy divided by technology. So use like the XLE ETF, Energy Select Sector Spider ETF, and XLK Tech ETF, divide the two by each other. The way that it's advancing, meaning energy outperforming technology, is a little reminiscent of what happened coming out of the tech wreck from 2002. Well, what else was happening back then? Again, it was a story of emerging markets. I'm not trying to beat the dead horse here, but it does seem to me that there's a major cycle shift that's happening. And by the way, that point is very valid. Sorry, so if you remove the top 5 tech names, the equity market doesn't look that bad. Yeah, I mean, sure, they drag the headline averages lower, but they also drag them higher, for the last decade because of this dynamic of zero interest rate policy. So my entire point here is that there's a much bigger shift happening from a cycle perspective, I think. And if I'm right that the catalyst is rising rates, or at least non-zero rates, there's a lot of interesting momentum you can get in some of these places outside of the U.S. that have cheaper valuations, which nobody's invested in, which everybody thinks will completely lag forever. They're not understanding that the game is changed now without the zero bound.
Well, why do you think tech stocks are decoupling from the rest of the index right now?
I mean, part of it is it's true that these are so-called long duration plays, meaning that, as rates rise, look, what was one of the major reasons that large cap tech companies did so well? Buybacks, right? Shrinking of shares outstanding. Well, what enabled buybacks? Zero interest rates. I mean, the tech sector was very apt to doing that for the last decade or so. So I suspect there's that headwind, right? And the reality is, I don't know, man. It seems like a lot of these tech stories are so saturated, right? Like it's more than just the argument of the non-profitable tech and them going through the devastation they went through since the peak in 2021. But it's like, you talk about an overinvested sector. How could it not be technology? And if that's the case, do you really want to invest where everybody else is invested, which is what basically passive averages?
It's interesting. You invited me to actually your Twitter space a while ago. It was a lot of fun, by the way. Thanks for the invite. And you asked me a question. You said, what is consistently the least popular topic on your show? So Kitco. And I told you it was anything to do with, NFTs, the metaverse, Web3. These are booming buzzwords that are hot in the tech sector. And they're not just buzzwords, right? I use that term sort of facetiously. But if you look at where the industry is headed and how they're positioned, you look at entire companies like Facebook repositioning themselves and naming them Meta. You see where people are thinking and how they're thinking and where they're going. Yet, interestingly, maybe just on this channel, it's not, performing super well. But this is the future of tech, is this nascent kind of concept that nobody really understands. How do you value that is my question.
Yeah, and also keep in mind, I think there's maybe a realization that there's no such thing as permanent tech leadership. I mean, I was seeing this strange argument that ChatGPT, this artificial intelligence chat thing, right? That's going to overtake Google in 3 years. And it's like, I don't know if that's going to happen or not. It sounds a little far-fetched, but who the hell knows? I mean, the nature of TikTok came out of nowhere. It started eating everybody's social media lunch. So, it's like the thing with technology is that it's apt to replacement with new technology, right? So other sectors don't have anywhere near that type of risk or dynamic. So yes, it becomes very winner take all, but it also becomes very possible that there's a new winner and suddenly the entire sector goes through an upheaval.
Yeah, Google is very worried right now. I read they threw some all hands meetings as soon as that came out. It could have the potential to challenge Google. Final question for you, Michael, and I'll let you go. The Fed, people want to know, are they done being hawkish?
I go back to, I don't think the Fed doesn't own the bond market. The bond market owns the Fed. The bond market is saying good luck trying to raise rates to your 5.5%, 6%, at least for now. And I say that because you never know, there could be another volatility spike that in inflation. I don't think so. Right? I think I think we're going to look back and say that the Fed clearly overdid the rate hikes. I think we're going to look back and we're going to say, the Fed should have said that inflation was transitory, which I know people hate thinking that. But the reality is the bond market is telling you that, right? So in terms of this disinflationary movement on the yield curve side. So if they are done, they're done because they admit that they were too they did too much, and they probably are done when they realize that they are doing what they always do, which is they act too late.
Hopefully this year is a year of a rebound. I don't know.
A year of normalization. It's just normal. Just give us normal. Give investors and allocators a chance, okay, for there to be some potential to make money in, again, a dislocation. Right, the bond market went through something worse than equities last year. I mean, on a Sharpe ratio basis, at the trough, bonds had a worse Sharpe ratio risk-adjusted return than equities in 2008 during the Great Financial Crisis. We went through something historic in the bond market. To think that that's not going to have at some point a lagged effect on equities, to me, sounds kind of crazy. But again, the nature of bear markets is that it creates these periods where you have these rip your face off melt ups and then a crash, rip your face off melt up, then a crash. Go back to that distribution pattern without QE. That's what you tend to see in distributions. You see risk in stocks. You see that it's not a smooth up move. And you see, hopefully, environments to be tactical where instead of trying to do the right thing by trying to go where it looks like momentum is happening, but then it fails miserably, this time the momentum persists. It's very hard to beat the S&P when the S&P is the only game in town. That's the dynamic that I think is finally over.
Yeah, we just wanted some hopium, Michael, but that's fine.
Hope is a strategy, David. Hope is a strategy. People say hope is not a strategy. It drives me crazy. But you have to have hope to stick to your strategy to see the cycle come your way. Hope is a strategy.
We have to also remember, I'll finish on this point. We have to remember also that after 2008, from 2009 until basically 2021, we had the longest bull rally in American stock market history. And a lot of fund managers who were, born, quote unquote, born during that time, meaning they started their careers during that time, they have never known a bear market. And now we've got guests on my show saying that we may not see another new high for another 10 years. That's just a prediction. I don't know if that's yours, but we have seen that before. In 2001, when the NASDAQ crashed, the NASDAQ didn't recover to its pre-2000 high until 14 years later or something like that. So we're going to get another decade of people not knowing what to do during a decade-long consolidation or bear market, whatever you may want to call it.
Scary. And by the way, it's funny because emerging markets went through a lost decade. The bond market went through a lost decade with what happened last year. I mean, if you look at total returns, you're almost back to zero, right? So it's I actually kind of agree. I think the U.S. is probably due for its own lost decade. We may be already at the start of it, but that doesn't mean you can't do something about it. It just means you have to look outside the U.S. to the areas which already went through their own pain from a multi-year perspective.
All right. Well, thank you, Michael. Good luck on your investments this year. Thank you for your analysis, and I appreciate your time today. Thank you.
David is the man, everybody. Make sure you follow him no matter where he goes and what he does in his career.
Michael's the man. I mean, Michael's the one giving the great information. So I appreciate your insights. Kitco has benefited greatly from you being on the show. So thank you for your partnership. And thank you for watching. I'm David Lin. Stay tuned for more.